Do you have highly appreciated company stock inside your 401k? If you do, are you thinking about selling those shares? Whether you're rebalancing your portfolio, managing risk, or just taking profits, if you have highly appreciated company stock inside your 401k, you might be about to make a costly decision, a mistake that could instantly wipe out hundreds of thousands in tax savings. You've done everything right. You've maxed out your 401k contributions, managed your investments, built significant wealth in company stock. But for executives with highly appreciated company stock in their 401k, there's a critical tax evaluation. Will you pay the highest ordinary income tax rate on your gains? Or will you secure the much lower long-term capital gains tax rate? Not considering the potential tax implications of selling those shares, that's 401k critical mistake number 4. And many advisors won't even mention this strategy that could save you hundreds of thousands in taxes. Hi, I'm David Dunn, a CPA, wealth, and tax strategist with David Dunn Wealth. I'm the creator of the Critical Mistakes series, my signature educational platform designed to help executives avoid critical mistakes, some costly, others irreversible. For over 30 years, I've helped technology and aerospace executives navigate the complexities of their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy. 401k critical mistake number 4. It's simple: selling your highly appreciated 401k company stock without understanding the potential tax implications. This mistake happens because selling feels like the smart, responsible thing to do. Rebalance your portfolio, reduce concentration risk, lock in gains. But here's what changes everything. When company stock is involved, that decision could cost you hundreds of thousands in avoidable taxes. Here's a potential problem with selling company stock inside your 401k. The moment you sell, you permanently lose the ability to qualify for special tax treatment on those gains. Let me show you what that really costs. Meet Michael, age 60, an executive approaching retirement. His 401k is worth $1 million, which includes highly appreciated company stock. Michael's tax situation: 37% ordinary income tax rate, 20% long-term capital gains rate. Michael sells his company stock inside his 401k to rebalance. Years later, when he withdraws that $1 million, he'll pay ordinary income tax on the entire amount. At 37%, that's $370,000 in taxes. But what if there was another option, one that required him not to sell first? There's a provision in the tax code many executives have never heard of called Net Unrealized Appreciation, or NUA. Here's how it works. Michael originally put in $100,000 to buy company stock in his 401k. The $100,000 is his cost basis. Over the years, that stock grew to $1 million, so he got $900,000 in gains. If Michael had known about NUA before selling, here's what would have been possible. If Michael qualified for NUA, he could pay ordinary income tax on just that $100,000 cost basis, and then pay the much lower long-term capital gains tax on the $900,000 in gains when he sells. Let's break down the tax. Tax on the cost basis: $100,000 at 37%, that's $37,000. Tax on the gains: $900,000 at 20%, that's $180,000. Total tax using NUA: $217,000. Compare that to the $370,000 he'd pay after selling inside the 401k. The difference? $153,000. But only if he avoids selling those company shares inside his 401k. Additional federal and state taxes may apply depending on your situation. Here's what happens when you sell your company stock inside your 401k. Once you sell, you no longer own those shares. the ability to get special tax treatment on that 900,000 of gain based on your original low cost basis is permanently lost. Now, you could buy back $1 million of company stock in your 401k after selling, but here's the problem. Your cost basis would be reset at $1 million. At the point of buyback, there's no gain in the stock, meaning no net unrealized appreciation, no special tax treatment. You'd have to wait for those new shares to appreciate before NUA would provide any benefit. Bottom line, the opportunity to capture tax savings on the appreciation that already occurred, it's gone forever. So how does the net unrealized appreciation strategy actually work in general? It requires specific steps and precise timing. Here's typically what needs to happen. First, you need to qualify for NUA. There has to be what's called a triggering event. Second, you'll typically move everything in your 401k that's not company stock to a new IRA through a direct rollover. Third, the company stock itself gets transferred in certificate form to a taxable brokerage account, not your IRA. Fourth, these transactions must meet the IRS definition of a lump sum distribution. And fifth, you need to complete everything so that your 401k balance hits zero by December 31st of the same year. Your specific situation may require different steps. This is where working with a qualified advisor becomes critical. So what should you know about that company stock inside your 401k? 3 things. First, verify you have appreciated company stock that might qualify for NUA treatment. Second, talk to a qualified advisor who really knows NUA. The NUA rules are complex, so find someone who knows them thoroughly to evaluate if this strategy fits your situation. And third, if NUA makes sense, work with your advisor to coordinate this strategy with your overall investment plan. At least 3 more critical mistakes can destroy your NUA opportunity. Be sure to watch 401k critical mistake number 3, 401k critical mistake number 5, and 401k critical mistake number 6. You've worked hard to build wealth through your 401k company stock. The net unrealized appreciation strategy isn't right for everyone, but if you qualify, it's one of the most powerful tax moves an executive can make. This is 401k critical mistake number 4, the second of 4 videos covering some of the most costly mistakes executives make with their 401k company stock. Be sure to watch 401k critical mistakes 3, 5, and 6 to see some of the other ways you can lose the NUA opportunity. Want to stay ahead of these issues? Here's what to do. Subscribe to my complimentary email newsletter. You'll get insights from the Critical Mistakes series delivered right into your inbox. Follow me on LinkedIn, YouTube, and Instagram for ongoing updates. And if you'd like to explore working together, schedule a complimentary 30-minute consultation at daviddunn.com. If this video helped clarify a complex issue, please like it, subscribe, and share it with colleagues who might benefit. Thanks for watching.